and what do we do about it?
Well, I think, first of all, investors must realize that the impact of a slowdown in the Chinese economy, which in my view is much larger than what the government has been reporting. The government says GDP has been growing at 7.8%. In my view, it's much lower because we have very reliable statistics, say export figures from Taiwan, export figures from South Korea, where the largest export destination is China. They are down year on year. Electricity consumption in China is hardly growing. And so I think the economy in China is rather weak. But of course, the markets have rallied because they think that because of weak economic growth in China, they will stimulate, that they'll print money like in the US and in Europe and so forth. And that may boost equity prices for a while.
No, hey, Mark, it's Tim, and thank you for joining us. I agree that I think this is kind of a perverse way to get excited, is that, weaker markets bring stimulus, which is artificial, and it's been proven to have less of a lasting effect. But where do you think the trade is then here? Because, in other words, we're at a place where a lot of these commodities are very beaten up. There's a lot of markets that I'm not sure I want to short here. I don't think the global growth story is in a very good place, but it's also a dangerous time to be throwing it all out the window.
I agree with you. The markets are very volatile, and it takes a lot of courage to be short. So I don't want to be short copper because copper can, like other markets, be manipulated because there are not that many players in the copper market. And so we could see a rally in copper prices, we could see a rally in gold prices, and so forth and so on. But where I see an opportunity is we have had now, for the last 1 year, bad news and worse news from Europe, and we have widespread Euro gloom. This is different. 2 years ago, there was Euro optimism, and now everybody is so down on Europe.
Right.
And the markets of Portugal, Spain, Italy, France, Greece are either below the March 2009 lows or close to these lows. S&P at that time was 666.
Mark?
Yes?
Mark, I'm going to jump in. It's been great to have you on the show. Thank you very much for your time. I want to just get a quick reaction from our traders. Ron, how did you feel about what Mark was saying?
There's a lot of truth to what he's saying, but I think, the consumer is still alive and kicking. There's still a lot of great buying opportunities. Prices have come down. We talked about it earlier. I like telecoms in the emerging markets across the board. I think you just can't ignore the consumer. Industrial may be down, but the consumer is still alive.
Look, I think Ron brings up great points. Emerging markets, if you look outside of China and Brazil, which are the two biggest economies, at least the ones people are the most crowded trades, the rest of EM's growing. If you look at Southeast Asia, if you look at Indonesia, if you look at what's going on in Turkey, if you look at other parts of Latin America. So EM is not falling apart. From a market's perspective, correlations are going down here. You don't want to be all in. And I think playing the market is a fool's game. I think buying good companies and shorting bad companies, as a hedge fund manager, that's what we try to do. But again, valuations will tell the tale.
So Rich, do you think that EM markets are on sale, or do we have to be very selective in our bargain bins here?
Well, it's both. EM markets are on sale. Tim makes a great point. Correlations are breaking down. You cannot paint the world with one brush anymore. If I can just respond to Mark's comments for 1 second, the thing that struck me, there is no one out there who wants to buy Europe.